ATT Personal Tax, the May 2014 paper, question 2, and we have adapted it for the 2021 tax year. My name is Omar Aswat. In July 2020, Harvey sold his 100% shareholding in Spectre Limited, so we have a disposal, an unquoted trading company, to his daughter, Rachel. Harvey had subscribed for the 1,000 share capital at par, meaning at face value, which is the 1,000, 20 years ago. He has never been an officer or employee of the company. That's important to understand. I'll tell you why shortly. As at the date of sale, the value of the shareholding was 1 million, but Rachel only paid 100,000. Spectre Limited holds no non-business assets. Calculate the chargeable gain arising on this disposal. So we have to calculate the chargeable gain arising on this disposal and the base cost of the shareholding in Rachel's hands, assuming that Harvey takes advantage of any reliefs available to him. That's for 3 marks. Now, from the question, there's loads of information that we can collect. And the first piece of information is he has never been an officer or employee of the company. Therefore, no entrepreneur's relief available. Why? Because one of the conditions for entrepreneur's relief is that you have to have been an officer or employee of the company. That's ruling out entrepreneur's relief. So that means the only other relief available would be gift relief. Another term is holdover relief, business asset gift relief, just different terminology, means the same thing. And it is under section 165 TCGA 1992. Why? Because it is an unquoted trading company. So because it is a trading company, gift relief will be available, and full gift relief is available. Why? Because Spectre Limited holds no non-business assets. So as you know, if there were some non-business assets, the gift relief would be apportioned accordingly. So to begin with, we can calculate the chargeable gain arising on the disposal. Who is making the disposal? Harvey. And also, because the disposal is to his daughter at an undervalue, because the market value of the shareholding was 1 million, but Rachel has only paid 100,000, that doesn't matter how much is paid. Why? Because Harvey and Rachel are connected persons for CGT purposes. And what is the effect of them being connected? Any disposal is deemed to be at market value. So deemed proceeds, you take market value, which is the 1 million. As per the question, the value of the shareholding was 1 million. Base cost for Harvey, well, he subscribed at par for the 1,000 share capital, which would give a gain of 999,000. Now, we have mentioned that gift relief will be available, and for your information, gift relief is a joint election that needs to be made within 4 years from the end of the tax year of disposal. So that needs to be made between Harvey and Rachel. And what the gift relief does is it rolls over any gain into the base cost of the new shares. Now, you need to keep in mind that any cash received by Harvey, so the 100,000 received, will be immediately subject to CGT. So that would be chargeable gain would be the 100,000 received in cash less the base cost of 1,000, gives you 99,000 being immediately subject to CGT. So that's immediately subject to CGT. And that is generally the understanding when any cash has actually been received. And the balancing figure is then the gift relief. Gift relief is effectively your balancing figure. And that is 900,000. As we mentioned, what does that do? That reduces base cost for Rachel's shares. So we said the proceeds are effectively 1 million. Reduce the base cost by the gift relief of 900,000 leaves Rachel with a base cost of 100,000. So that is effectively what she paid for it. The base cost for Rachel is what she actually paid for the shares. That's for 3 marks. Marks can be picked up quite easily on this question, but the primary marks would be understanding deemed proceeds and then the gain. The gift relief, along with the chargeable gain being calculated, would give another mark, and then the base cost would give the third mark. 3 marks.